It starts with a number most people never think about: 0.0001%. That is the slice of the global financial system that quietly decides fortunes while everyone else panics. The news will scream about recessions, markets crashing, inflation spiking, jobs lost, and yet there is a hidden plumbing beneath it. All that makes the richest people richer when everything else appears to be burning. Picture this. Stock tickers turn red, headlines blare crash, and the average person watches their 401k shrink in disbelief, while somewhere deep in the financial machinery a mechanism hums quietly, siphoning value into vaults no one sees. What is this? How does it work? And why does the very thing that terrifies everyday investors become a secret growth engine for the ultra-wealthy? Today we will follow the money, but not in the obvious places. Not in Netflix charts or Twitter memes. We will peel back the veneer of fear and hype and trace the invisible channels that rewrite wealth during a crash. The reason this matters right now is simple. We are living in a world of recurring crises. Markets are more interconnected than ever. Central banks intervene with dramatic force. Governments borrow trillions more than they used to. And yet, when the next downturn hits, and it will, most people will still see the headline numbers and think they understand what is happening. They won't. Few do. And as always, misunderstanding is where loss finds its home. So let's begin with a story, not a lecture, because the truth about money flows through people and choices, not charts and equations. Imagine two households. One belongs to a middle manager named Karen. The other belongs to a billionaire investor called Marcus. A recession hits. Karen feels it immediately. Her bonus disappears. Her investments lose value. She checks her retirement account with a sense of dread. Meanwhile, Marcus barely notices. His net worth blinks. Down a bit on Bloomberg, but within months he is buying stakes in companies at fire sale prices that no one else can afford. Within years, he's reported to be wealthier than before. That feels absurd. Shouldn't everyone lose money in a crash? Shouldn't value evaporate for all? Intuitively, yes. In practice, no, because there is a hidden plumbing in the financial system that roots risk and return in ways most people never learn, and it's this plumbing that billionaire investors exploit. To understand that plumbing, we need to step back a bit and look at how markets actually operate. We've all seen the dramatic graphs with jagged lines up and down. We've all heard commentators talk about fear and greed, but those are feelings, not mechanisms. Beneath the surface, there are specific structures: credit markets, derivatives, central bank liquidity facilities, private credit, and what is called risk transfer mechanisms. These are the pipes and pumps of the financial world. They determine who actually bears loss and who gets a chance to buy assets cheap. During a crash, the apparent chaos is just the visible part of a system that directs flows according to contractual rules, regulatory priorities, and the incentives of powerful players. A key part of this plumbing is something most people barely hear about: credit default swaps and other derivatives. These are contracts that essentially let people bet on the failure of companies or debts without owning them. Sounds abstract, right? But imagine this. Marcus doesn't need to own a failing company to profit from its collapse. He buys a derivative that pays him when the company's bonds lose value. When the crash comes, those contracts pay out. Meanwhile, regular investors holding the actual bonds take a loss. That's one mechanism. Another is central bank interventions. When markets wobble, central banks step in with massive liquidity money they effectively create out of thin air to stabilize banks and large financial institutions. This was visible in 2008 and in the COVID crash of 2020. The Federal Reserve, the European Central Bank, the Bank of Japan all flooded the system with cash. What does that mean? It means asset prices didn't crater as much as they might have, but who benefits most from that liquidity? Not the average investor with a retirement account. The biggest beneficiaries are those who already own the assets that get inflated by that liquidity: stocks, bonds, private equity. The billionaire with a diversified global portfolio, leveraged to multiply returns, suddenly has a safety net that ordinary savers do not. We often hear that the market is a democracy. It isn't, it is an oligarchy with rules that favor insiders. Let's make this concrete. When markets fall, losses are realized only when someone has to sell an asset at a lower price than they paid. Billionaires and large institutions rarely have to sell. They have the capital to hold through volatility. Even more, many of them have lines of credit against illiquid assets that let them borrow rather than sell. Karen, with her modest savings, has little choice but to accept losses. Her employer might cut hours, her investments might slump, and she can't borrow against them easily. The billionaire? He can borrow against his private jet or stakes in companies that aren't publicly traded and use that cash to buy more when prices are low. That's one of the hidden plumbing advantages: access to credit that functions as a bridge over crisis waters. Then there's private credit and private equity, another part of the plumbing invisible to most. When public markets crash, private markets often move slower or don't fall at all. Why? Fewer Mark II market requirements. That's technical jargon meaning private assets aren't revalued every second like public ones. It's easier to hide losses. For someone with deep pockets, private equity becomes a fortress in a storm. Funds that Marcus controls don't have to shout their value every day. They can hold and wait. And when the storm clears, they re-emerge, often with even more control over their assets because they bought more while others were selling. We need to pause here and let the irony settle. The mechanisms designed to add stability to markets, like central bank interventions and derivatives meant to spread risk, end up concentrating wealth instead. Systems intended to prevent panic become tools for the well-insured to profit from panic. That's the uncomfortable truth. Most financial news never explains. It's not that crashes don't hurt. They do, but they hurt different people differently. The plumbing directs the pain to those with the least power and routes the benefits to those with the most. Now, some skeptics will say this is conspiracy thinking. It's not. It's mathematics and incentives. Let's talk about numbers for a moment. During the 2008 financial crisis, the U.S. Federal Reserve's balance sheet expanded from about $900 billion to more than $2 trillion in just over a year. That's more than double. In the COVID crash, it exploded again from around $4 trillion to over $7 trillion within months. That is liquidity injected into the system. Those numbers are real. But what happens to asset prices when that much cash chases a limited supply of equities and bonds? They go up. The people holding those assets see their net worth rise. Meanwhile, everyday people who keep cash under mattresses or in savings accounts see their purchasing power erode due to inflation. They don't own enough of the assets that get pumped up by this liquidity. That's not accidental. That's the consequence of a system where money is created and distributed in specific corridors, not sprayed evenly. It's a plumbing issue. But how does that secret plumbing actually operate? Let's break it down step by step in the simplest terms without dumbing it down. Step 1. A shock hits the economy. Could be a debt crisis, a pandemic, a war, or just a sudden loss of confidence in markets. Step 2. Investors start selling assets. Prices fall. Panic spreads. Step 3. Central banks step in with emergency measures, lowering interest rates, buying government and corporate bonds, offering cheap loans to big banks. Step 4. The money central banks inject doesn't go directly to regular consumers. It goes to financial institutions, which then use it to buy distressed assets. Why buy distressed assets? Because they rate cheap and because the financial institutions and wealthy investors have the leverage to amplify returns when prices rebound. Step 5. The wealthy buy low. When markets stabilize, they sell high or hold for long-term gains. Rinse and repeat. At each step, notice who gets a seat at the table and who does not. Central banks negotiate with big banks, not with individual investors. Financial institutions access cheap funding that is unavailable to the broader public. And the wealthy, those who control large pools of capital, are in a position to benefit from buying low. Meanwhile, the middle class watches from the sidelines or suffers losses on the assets they do hold because they don't have the same tools or access. Here's another hidden layer: derivatives and hedging. Most people think hedging is just insurance. It's not that simple. It's a way to transfer risk. If Marcus thinks the price of a company's stock is going to fall, he can buy a derivative that pays him when it does. This doesn't save the company. It doesn't help workers. It simply reroutes value from the falling asset to his pocket. This isn't illegal. It isn't unethical in itself. It's just part of the plumbing. But when crashes happen, these instruments amplify the advantage of those who know how to use them. The wealthy don't just survive the crash, they profit from it. Let's bring this into a recent context so you feel the full weight of what is happening. During the COVID crash, public markets fell sharply in March 2020. Headlines: screamed recession. Investors panicked. Yet by late April, markets rebounded dramatically. Stocks reached new highs within months. Why? Because central banks unleashed unprecedented liquidity. But here's the twist: the liquidity didn't make Main Street safer. It made Wall Street richer. Housing markets soared because cheap money flowed into real estate. Equity markets climbed because cheap money pushed investors toward risk assets. That is right, a public health crisis turned into a wealth creation event for those already rich. The invisible plumbing rerouted flows into asset classes that the wealthy dominate. Most people experience this moment as a baffling contradiction. How? Can markets go up when so many people are hurting? They asked. The answer lies in the difference between the real economy and the financial economy. The real economy is about jobs, wages, and everyday commerce. The financial economy is about assets, leverage, credit, and liquidity. They are linked, but they are not the same. When the financial economy gets a flood of central bank money, asset prices can inflate even as the real economy contracts. The wealthy live in the financial economy. Most people live in the real economy. That distinction matters a lot. Now let's talk about private credit and shadow banking. These are parts of the plumbing most people never see. Traditional banks are regulated. They have oversight. But shadow banks, investment funds, private lenders, hedge funds operate with far less transparency. During a crash, when traditional lenders tighten credit, shadow banks often step in with financing. Who controls shadow banks? Wealthy investors and large institutions. So while the average business struggles to get a loan, private equity funds swoop in with capital and terms that ultimately give them control of the business. When the economy recovers, guess who profits disproportionately? The private lenders. That's another part of the unseen plumbing. At this point, you might be thinking, isn't this system rigged? Rigged is a loaded word, but it is engineered. Yes, it is engineered to prioritize stability of financial institutions over equitable distribution of risk. It is engineered so that liquidity arrives where it can most quickly restore asset prices, not where it can protect individual livelihoods. The intention isn't malevolent. The incentive structures and historical evolution of the system produce these outcomes, and the people who understand and operate within this plumbing benefit from that understanding. So what are the implications? First, if you think market crashes affect everyone equally, you are misunderstanding the system. Crashes redistribute pain and opportunity unevenly. Second, if you believe owning assets is enough, think again. You have to understand what kind of assets and under what conditions those assets are protected or exposed. Third, the next crash won't feel like the last one. Financial engineering evolves. New instruments, new channels, new mechanisms will continue to obscure how wealth flows. But the pattern is consistent. The invisible plumbing will shape outcomes long before markets stabilize. And now we arrive at the final uncomfortable truth. Most financial education focuses on what's visible: stock prices, economic reports, interest rates. But the real action happens in the plumbing. Credit flows, derivative contracts, central bank facilities, shadow banking. These are the forces that decide who loses and who gains during a crash. Understanding them doesn't guarantee success, but ignorance almost guarantees disadvantage. So here is the question that lingers long after the markets close and the headlines fade. In a world where the hidden plumbing determines wealth and security, how do ordinary investors navigate a system not built with them in mind? That question has no easy answer, but it is the question that matters more than any stock tip or economic forecast.